Markets looking for a way to react to this. What's the takeaway from that number in your view, Anastasia?
I think it's actually exactly the number and the details of the number that the Fed wanted to see. I mean, look, they're trying to engineer a slowdown in the goods sector of the economy, in the inventory sector of the economy, in the structures sector of the economy. And that's exactly where we saw the pullback in this GDP report. One thing that Fed Chair Powell said yesterday is they want to bring down demand in certain sectors while supply catches up. So that's exactly what this GDP number shows. Now, if you look through the other details of it, if you extrapolate private inventories, the GDP actually would have been positive, and consumption, the 70% of this basket, is up 0.7%. So I think that's exactly the recipe that the Fed sees to bringing down inflation, but at the same time achieving some sort of softish landing. And I think that's what the markets are recognizing here. That's why you're not seeing a whole lot of movement in the futures. And I suspect that as we move past this report, we'll focus on the fact that the Fed is now going from this emergency state of rate increases to something a little bit more normal. And that something a little bit more normal should actually be positive for stocks in the second half of the year.
So a soft landing could be orchestrated. And then, as you say, on the other side, some of this inflation you see as can I use the T word? If it's not wage price spiral, it's in some things that might sort of self-correct in the next year or so, some of the goods that you were talking about. So that does seem positive. And that's, I guess, the point I was making. Maybe we don't really have the stag, and maybe we don't really have the deflation. Maybe we don't really have either, and we're getting a little bit too concerned of a return to the 70s. It just isn't in the cards.
Well, I think that would be nice to make that conclusion, but I don't think we can completely call this all transitory. I do think that this correction in the goods sector will play out, but it's not going to bring inflation down to 2%. I mean, you can't, quickly solve the wage issue. You can't quickly solve the shelter issue. That's what really worries me, that 30% of the CPI basket, and we can't print more housing. So the fact that we're pulling back on building structures may actually not be a good thing for inflation. But I still think there is a chance to bring kind of the core inflation down as well, because one thing the Fed said yesterday, there's a lot of financial condition tightening that has already occurred, and the future impact of that on the economy is still in the pipeline. So the fact that they're pausing, the fact that they're close to neutral, they're going to get a little bit more restrictive. I think it just gives the economy time to absorb this rate of increases, and let's just see how it shakes out. So I do actually think they're starting to strike the right balance between doing what they have to do, but not doing so much as to tip the economy over. The fact that Fed Chair Powell is so focused on achieving this soft landing, I think that's actually a positive development for markets.